That was a bit of a setup of where we are today. Just wanted to invite groups' reactions. Is there any disagreement with the context, or I think we are all on the same page that today where we stand, we really need to bring things together.
Yeah, I think what you have said is the need of the hour. And of course, all stakeholders seems to be perplexed as of now. What's the way ahead? I think in that, if we look at it in that dimension, the context is appropriately set.
In fact, I would like to add here is, let's go back a little. One thing which I am a firm believer that all bad loans are underwritten in the good times of the economy. Go back 10 years, boom. And you know, in the process what happens, even, don't misunderstand me, it's my experience, somebody who was a trader, he became a manufacturer. Somebody who was working for a big firm, he also becomes the promoter and the manufacturer. And we, as a lender, what we did, in the name of entrepreneurship, to help out the entrepreneurship, we also helped. Now, when the capacities went up, when the economy was booming, and that met with the downturn. And the downturn, the bottom part of this U is so long that nobody has the answer. Because typically, we the lenders, Mr. Jain, the two of us sitting here, we are asked, stress kab kam hoga? I need to ask all of them who ask us this question, give me one date or 1 month or 1 year when the economy will pick up on a sustainable basis. Keep us 6 months behind that, it will be all okay. Nobody has that answer. And in the process, what happened? When all this happened, the downturn, economic downturn came in with the capacity expansion. The resolution processes got longer. And it's not just the money part. We are one of the stakeholders. There are other stakeholders. Why capacities went up? Because economy is demand. Economy is demand and there was a demand. So both put together. Now they are also government. Government wanted us, especially the public sector bank, to help out all these entrepreneurs or the industries. And you said, iron is steel power. We are talking on one hand 7.9 or 7.8% growth. Is it really possible without these sectors being fixed? No, bankers, and we say it with the view that we are sleeping partners. We are not in slumber, but ultimately we are in the business of banking, not running the enterprises. It is somebody else's. And when you also touched upon in your this quick few slides that what all should come with what stake as a stakeholder. I don't know whether this is the right forum to say so, but when government, we are asked to take the OTS or haircut, why can't there be haircut in the tax collection also? Okay, for next 3 years, your tax rate would be this. So everybody looks at just the lender or the banker to fix the woes which are in there for last 4 years or so.
Actually, fantastic. I think it's well laid out that it's not really the banking fraternity which is to blame for the situation, or they can't singularly find a solution. It is a much broader problem which encompasses all elements of economy, and we have to find a holistic solution. So I think let's move on. I think what the intention was, therefore, to deep dive into few specific angles. So let me first bring out what is the industry saying, right? I think we'll come to the lenders in a bit. I think what the industry is saying, and there are a few important points to debate here, right? Is this. Now we work with many people in these stressed sectors, right? And these are few of the key points that stands out. I think the first point that stands out is that everybody is painted with the same brush. Not everybody is the same. There is today no differentiation between promoters, right? Between repeat and first time, between the ones who have actually been fair to the business versus who not. And the effort in general of setting and operating a business in India is not well recognized. I think that's the one point that people make. The other point that people make is that most of the schemes in the last couple of years, especially SDR, was aiming at taking away management control, right? They really have no desire or intention to do that, and they have no incentive to do that. So industry really, is that, they've been running the search for investors without genuine intent or genuine ability to do that. The third point, they're all actually scared. They're scared about the lawsuits, the legal actions. It is not like, they are, with the specific examples like Kingfisher that have happened, there is a fair underlying, thread that people carry. Fourth, what is happening in this process is that the business is certainly suffering. If you see the working capital has got squeezed, right? Nobody wants to further fund the engine, and as a result, the entire credit control in the economy has caused further ripple effect. And obviously, longer projects today nobody is interested in looking at. And as a result, even projects which are halfway along or which are completely viable, they are looked at it with the same lens because there is complete trust deficit in the system. And in such trust deficit, right, no lender is today willing to investigate and even evaluate projects which have high viability, which further hurt the business interest. So that's what the promoters are saying, right? Some of these are worthy of discussion and debate. So what we'll do is take a few questions and get the panel's point of view. These are questions that we've collected through discussions with many of you. So the first question that we wanted to discuss was do we really need the promoter and the same promoter to run the business? And can we differentiate between them? And is there any way you can actually make out that A is good and B is not? So can I request the panel's views on them? Few of you, maybe, so Tiwari, if you could start. Do you think promoter continuity is critical for business?
No, first thing to me, I mean, all are good people, including the promoters. But to me, the promoter would be better if he is continued to commit in the business enterprise with who has got confidence and intent to put some more skin in the game. For me, it's a better promoter. Ultimately, you also talked about briefly here that there have been avenues, but all of them they touch upon, again, changing the promoter or management. And in the background, that the larger part of NPA is coming from is steel, iron, power, textiles, roads. It is not that easy to find a new promoter. And if we are asked to give this management to the professionals may have skill sets, but they don't have the risk capital. So that is the paradoxical situation. And our experience has been in the bank that those promoters, and I respect all the promoters, those promoters who have this in their DNA to run the businesses, they are more willing to come around than the first timers. Because as I said before, a trader became the manufacturer. You won't find them coming that quickly around the table. Of course, things have changed. They come reluctantly, but not with the absolute positivity of what we are looking for. Rashesh bhai, ARCs, they are also resolution oriented. But so far, in my experience, and I would like to dilute my comment about, I was talking to one of the Arcel MD, that none of the ARCs, they have come with the turnaround program. That is the problem. So whether we give it to the Arcel, they become the new promoter, or the new promoter whom so far we have not been able to found, and all these SDRs, S4A, or 525s, the moment we talk about the new promoters, so far it's been a dull response.
Mr. Shah, you deal with a lot of promoters in the role that you are in. How do you see them? Do you see them as a homogeneous set or wide variation? And what is your view? If you take over a company as an investee company, would you want the current promoter to continue?
I think obviously there is no homogeneity, because if there is no homogeneity in everything else in our existence, there won't be any homogeneity amongst the promoters. But I think there is a lot of conversation about who are the promoters with the bona fides and the mala fides and all. But I do believe that eventually, whether it's a good promoter who's fallen on bad times because some approvals didn't come, or a bad promoter who had bad intention, ultimately a lot of this, when you look at resolution, we as ARC, when we acquire an asset, the first and primary driver has to be economics. And you have to make an economic call in terms of whether to continue with this current management team or do you have alternatives. So I think eventually all this boils down, and even a few of the things that you had earlier put on the screen, I do believe that it is not about the management control being taken away. It is the economic upside. And currently, a large part, the three constituents that you had highlighted, the existing promoters and management, the bankers, and the new investors, whether it's ARCs or outside funds, there is a process by which how the economics of upside will be shared by them. Obviously, the funds want a fairly good return on a risk-adjusted basis. The banks want to take as little haircut as possible. The promoters want to maintain as much upside as they can keep. And in this, I think currently this process has broken down. I think the new bankruptcy code will allow us for having this process going through smoothly. So instead of trying to say so-and-so promoter is good, but poor guy has fallen on bad times, I think we have to be driven by economics, that how, and if the promoter is required because of his expertise or because of the skill set to keep in that, then you need to work out some skill in the game for him. Or if he is not required, then you should be open-minded about it and bring in, experts from outside and incentivize, for them. But currently, a lot of things are stuck purely for economic reasons. Nobody wants to share and give up because when the investor comes in, the promoters are saying, let the banks take a haircut. The banks are saying, let the promoters give up the equity upside. Here, I would just maybe, give a small historical anecdote to this. If you see, there have been three crises that at least I have seen. I started my career in 1989. I was in ICICI, so I started in project finance. And the first crisis we saw of the project loans going bad was between 91, 92, 93, where a lot of, the paper companies and cement companies had struggled at that time. In those days, we used to have a convertible clause in all the loan agreements that the institutions, the bankers can convert the loan at par value. And I remember we in ICICI made a huge amount of upside because you converted a lot of the loans in bad times into equity and enjoyed a lot of upside. The promoters did not enjoy the upside. Then we came to 2000, 2001 to 3, where now the promoters did not want to give away the upside, and we had the entire CDR process. In that process, if I remember, a lot of the banks took a huge amount of haircut, and the promoters kept the equity upside. And when the economy came back from 2004 onwards, entire upside were enjoyed by the promoters. A lot of companies which are almost bankrupt started coming back very strongly. Currently, we are stuck in between, whether we're going to go back to 91, 92, 93, or we're going to go back to 2001 to 3. The promoters obviously want to go back to 2001 to 3, while all the banks want to go back to 91, 92, 93. And eventually it's going to be this, how we resolve this issue is going to be the important one.
It's a fantastic summary.
I only want to add more piece on this. As far as the business risk is concerned, that stays with the promoter, all said and done. So as far as banks and financial institutions are concerned, they are actually putting a stake on the promoter and his comfort and the confidence into the risk which they are assuming. The other piece is that in a situation like this, unless and until an atmosphere, and in fact you also mentioned lack of trust among the stakeholders, unless and until an atmosphere is created where all stakeholders have a confidence that there is going to be a fair deal, I think things will not move ahead. So I think an atmosphere is required to be created for a fair deal kind of a transaction to happen.
Ms. Mody, you also deal with a lot of promoters. How do you see the situation? Do you see them wanting to continue to run the business, open to exit? Do you see them all with the same brush?
My own view is that there are too many stakeholders which are still misaligned. So the promoter is basically thinking, if the equities seem to be zero value and I'm getting nothing, then why am I working for the bank, right? And unless he has a personal guarantee out there, or his wife has a personal guarantee with their large bungalow, the incentivization to bring him to the table needs to be discovered. So in the Ultratech JP deal, I think Mr. Khara, State Bank and ICICI were running it. I think that the promoter got at least some skin in the game through the NCDs that he got in the company. So how do you get the promoter to put in, as Rashesh says, or as Mr. Khara says, more skin in the game? You have to give him the belief that if he sweats again, he will get something again. Then you have the new investors. And in some of the cases that we were exploring, the promoter would actually phone up our client, special SITS fund or whatever, to say that I will back you if you give me something. And of course, that something can't be an undisclosed something. And therefore, the banks have to accept that if they want the better situation for themselves, the promoter has to be covered in some way, transparently. Then, of course, as your chairman, Mr. Khara, says, the constant hounding of the CVC and the CBI and the bank board, hopefully, to help solve that process. How do we get senior bank officers to agree to a proposal which may have some risk without the threat of them being hauled up later? And then, of course, you have the investors who are basically saying it's worth only 30%. The banks are willing to write down maybe 40, 50%. Where is that funding gap going to come from? And are the banks able to take the bolder step, which I think is difficult, to write down to 70+%, again without the CVC or the bank books looking terrible, and ultimately the government having to fund the capital shortfall? So I think promoters have come to realize now that it is not that they can defer the problem indefinitely. I think that time is gone, because that time is gone for the banks. And the time is gone for the banks because the governor has made it clear it's gone for the banks. So with the JLF and the CDR and the SDR and the S4A, whatever these schemes are, I think they're work in progress. I think Reserve Bank has asked for comments. Reserve Bank wants to make the schemes more practical and viable. But ultimately, how much haircut can the banks take? And how much of that haircut can legitimately be given to the promoter who has caused the haircut to happen in the first place? I think these are the issues.
Fantastic. I think just in the spirit of moving on, I think the next very specific question is that in this kind of a limbo, when warranted and when you see the asset value really suffer, should the lenders continue to provide additional funding where viable? And is there any such thing as being viable? Do you even know what is viable? Right? That's the question, and I would like to pose to both the banking representatives here. Mr. Khara and Mr. Tiwari, if you could share what you think.
Well, of course, when it comes to a situation where an asset is already impaired and to really think in terms of additional funding, it is possibly a very, very difficult question for any practical banker. But nevertheless, we have to be mindful of two facts. One, of course, is a situation where we all know that leverage is quite high, and even today morning also when Governor Rajan was also talking about the leverage being high, and we have to create a situation where equity could be there. Equity possibly may not be forthcoming. I think we'll have to possibly think in terms of mezzanine, and maybe we'll have to think in terms of market-related instruments, maybe NCDs kind of a thing. Because as we all observe that, there is a huge demand, particularly from the global investors who are yield chasers. They are looking at the opportunities, particularly in India, but at the same time, they are looking at the credible system which can actually take care of their interest. So I think if we succeed in creating that kind of atmosphere over here, and we should be in a position to get the money from such kind of investors who are willing to put in the money. So I think it is essentially the need is to create an ecosystem which gives them a support and a comfort, and possibly with that we can take care of the lender's interest, we can take care of the borrower interest, and we can take care of the investor's interest.
Can I add a small point out here? I think this additional funding, it's not something the banks have to give. You can access the additional funding from other sources also. And in a way, I think trying to get it from other sources will also validate the revivability or the restructuring package that is there. What is important is that this additional funding comes in a super senior form. There is something called a priority loan. And the idea is to bring it because after the asset is impaired, if anybody else is giving additional funding to that, it is truly high risk. And we need a structure around that. RBI has been speaking about it, to create this, a super senior priority loan, which goes in and then comes out first at a reasonable, rate of return. If we can put that structure and insulate that from the impairment of the old asset, I'm sure the existing banks as well as quite a few NBFCs and other funds will be happy to fund all this. So I think the problem is not the additional funding. The problem is the assessment that it can be restructured, and this additional funding is the only gap that is remaining. Everything else is in place.
Fantastic.
If I may add, Rahul, there, let's peep back in the recent history, about 8-10 years, when the first round of restructuring was done. I have no reservation in accepting that the first round of restructuring which was done, it was little cosmetic. We were learning the restructuring, and nobody, no whistleblower then said that this project life is 25-30 years, you are squeezing cash flows in 15 years, it's bound to fail. And it failed. So thereafter, first time restructuring, it was, not very ideally done, it was just done. And talking about the additional funding and viability, if viability is just about Excel sheet, it won't work. It should go beyond that. And we as a lenders, Mr. Khara would agree with me, and he said so, if we are given that free hand, if that enterprise has got economic value, we as a lender, we have no divine right, quote unquote, to kill that economic value of the. But then the question is, we are hounded 5 years later. We won't remember what we did 5 years back. And then if you are, in the hindsight, if you feel that I may be asked these questions 5 years, 2 years, 3 years down the road, I won't remember it. Having said that, still we do it. So going forward, if it's worthwhile, it has got economic value, promoters are on board, yes, we would be willing to do that.
Actually, this is a very good segue into our next discussion, into what the lender's perspective is. But just to summarize before that, I think some very good points have been made. I think there was a clear point that, the early rounds of restructuring was people were still learning, and it did not really address the core of the issue, right? Also, there was a very good point made that today the gridlock is really on the commercial terms. I think the three stakeholders, right, all have come to terms with the basic issue. Now it's a matter of finding the right via media where the banks, the promoters and the investors are willing to correctly assess the past, correctly assess the future, and decide how much of the past we will bite and how much of the future we will bite. It's a commercial process, but it requires trust in the system, and everybody needs a fair share for their interests. I think what has come out clearly is that taking the promoter out from business is really not the solution, because the sectors that we are dealing with, only he knows how to operate that business. And if you want him to operate the business, there needs to be enough incentive or skin in the game for him to actually run the business, because the primary shareholder at that point actually may be somebody else. Right? So there has to be enough economic upside for him to ensure that the business revives. What has also come out clearly is that for the investor, which is actually coming in at high risk to really revive the business, there needs to be a preferential model or some way of really capturing a share of upside. And for the banks who actually take bulk of this on them with the past debt writing off substantially, they obviously then need to have a very large share of the equity upside. Otherwise, it's really economically not making sense. So that's really some of the conversations we had. I think the next part of this puzzle is then, if this can be administered, why is it not getting administered? Really? And what are the challenges that bankers or the lenders are facing today? So I think there are 3 points. We spoke to a few, we worked closely with you, what we have heard. Firstly, I think just a recognition that this is actually, there are limited options for timely intervention. Firstly, they get to know this problem quite late, and then with the account patch-ups, it's really too late before the time that reality hits. And then the other point is there are very limited avenues for early exits. As we all know, the entire ARC regime, the AMC regime is still in the process of getting mature. So if a bank even decides to exit early, today the model, the architecture is not there. What we hear most critically is that swift decision making and execution is very, very difficult. The coordination amongst banks is a real challenge. We see it also from the side of promoters, and even the bankers agree. Even if in the JLF a decision has been made, to ensure everybody else follows through is very difficult. It's not one bank, it's many. All of them have to be taken along. the decision making is not, straightforward. There is a lot of fear of PVC, all kinds of questioning after a few years. Nobody wants to take exceptional decisions. While there are, other clauses like OC that are coming, we have to still see how much operational bandwidth they will have, and whether they will actually be accountable to the decisions or actually just the process. So, in light of this, today banks unable to take decisions, unable to stand up and say, okay, this is the solution, and not really empowered to do so. On top, the options like BFR are used by historically promoters for stalemate. Right? Now we are seeing changes. The insolvency code hopefully is a step in the right direction. But in light of this, right, there is a real discussion on how can we make swifter decision making across banks, especially in the light that majority of them are public sector. I think one comment we heard was actually this problem would not have existed if majority of these were private sector banks, because they would have found their solution. I don't know how true it is, but at least a good food for thought. The other point that came out was the focus is really on provisioning and not long-term recovery. Now the policy focus has been always on how do we mark down minimum, how do we ensure this quarter we get minimum write-offs, right? And only when the problem becomes that large, because the way our norms of recognition are, that at some point it starts to not make sense to anymore continue, then one starts to really solve the problem and get the asset out of the books. What we also hear is the instruments to capture upside, if you're going to take that much haircut, is not there. How do I ensure very large upside comes, and do I have the bandwidth to even understand the business dynamics behind it? Because I'm really not a banker, I'm not really a business owner, I'm a lender. So these are the thoughts. I think we also did a bit of a research on how has the world dealt with this. This is not the first time in the first place in the world that distressed asset situation is ballooned, right? And there are some interesting learnings. If you look at different examples, I think over the last couple of decades, between different countries, different types of solutions have been tried. One example to call out here is what was done in Europe recently. In few countries like Spain and others, they basically created a bad bank. Now, let's not get carried away by the term. It's a bank which is equipped to deal with stressed assets. So what they did was pulled in all stressed assets across bank into one entity, and they created the right capability and authority levels to deal with the problem, as against fragmenting the problem across multiple stakeholders. Another solution that was tried in South Korea, which worked quite well, was actually to create a strong government-backed AMC, which was asked to buy out the debt across banks at a certain term, and then actually deal with that problem in the right way, with a longer-term intent to solve the issues with the right competencies. Another solution tried in some of the other countries was different forms of AMCs, whether privately managed or state-owned. In China, which actually, a couple of decades back faced a similar issue, they created 4 or 5 large state-owned AMCs, which actually pulled in and took over the decisions from banks at a certain rate, and then they ran that turnaround so successfully that today these AMCs are actually investing in overseas stressed assets. So these are some solutions that have been tried. I think some learnings can be drawn from them. What you would do now is actually discuss a few of these. So I think the first, really the most important topic for discussion is how do we enhance coordination and decision making within banks. It has many elements, centralized management, AMC, bad bank, all of these are options, but the underlying problem is coordination and decision making, alleviating CVC fear and getting the right decision at the right time. So may I request Mr. Umarji to first share your point of view. You've dealt with banks for years.
I need to comment very quickly, half a minute. You did make, Rahul, one comment that in the same economy space, how can private sector banks can get away or didn't do that bad as the public sector banks? No, there's a report of BCG only, which says, Mr. Sinha's report, which says that the last 5-year plan, about 500 billion was envisaged to be invested in the infrastructure. Now, we did talk about PPP, but where from that public part of PPP came? From the public sector banks. So we should not forget that the nation building which public sector banks have done, and most of us, let me accept that, I respect private sector banks, what Pramit was saying, they brought in efficiencies in the system. And we have been following that. But the question is, one bank did the project appraisal, we followed that. Banking is trust. Trust was not there thereafter. That is the answer.
Right. No, 100%. I think the role of the public sector banks in building the nation is absolutely fully understood. I think the specific point was now in this grid law, can we really have the right enabling environment to take swifter decisions? That's the so much if you could.
Yes, please. Thank you. The major issue is about giving further finance to a stressed unit and the reluctance on the part of public sector bankers to take decisions on such issues, actually. Now, if you go to the root of the matter, the jurisdiction of CBI and CVC becomes applicable because the public sector banks are owned and controlled by the central government. They are authorities and they are covered by the definition of state under Article 12 of the Constitution, and the chapter relating to fundamental rights becomes applicable to them. Now, the employees and officers of the bank also become public servants for the purpose of Prevention of Corruption Act. Now, there is one solution for this entire problem to enable public sector banks to function as any other private sector bank and have a freedom to take decisions and take whatever decisions they want to take without being questioned at a future date by some police authorities as to why did you decide to give so much money to such and such company. Now, if this is to be achieved, what needs to be done is convert the public sector banks into companies. They are at present corporations established under an Act of Parliament. You convert them into companies and reduce the shareholding of the government from 51% to 49%. Once that shareholding is reduced, they will cease to be authorities or state within the meaning of Article 12, and they will not be subject to jurisdiction of CBI and CVC. They will cease to be government undertakings, which gives the jurisdiction to these authorities to question their decisions. Now, this could be perhaps also done while making the change. You will have to pass a law for this purpose, and that law can reserve certain rights or privileges for the central government in the matter of implementation of priority sector schemes or weaker section financing, etc. That could be reserved while making that law. But at the same time, taking away the control and ownership right over the public sector undertakings, this will solve the problem. This will also solve other major issue which was discussed in the previous sessions, which are relating to HR. Now, when the chapter of fundamental right is applicable to public sector banks, they cannot deny equality of opportunity to any person or equal protection of the law. So when you go to a institute of management and select candidates to be appointed as officers in your bank from a particular institute, the question will be, why not other institutes? Why not other management graduates? They are denied the opportunity to be considered for appointment in your bank. Therefore, it is discriminatory and it is invalid. Now, this problem is not going to be solved unless you change the structure of the public sector banks.
So I think thank you very much. An extreme point being made here regarding the ownership structure of bank. Any other thoughts, Mr. Khara, and then Mr. Tiwari, if you could share. You work with the banks, you see the cooperation amongst the various banks. How do you feel that is, and how could that be strengthened?
Yeah, as far as again, when it comes to what the question in focus is that how do we enhance the coordination? Of course, each of the bank being a board-run bank, and they have their own compulsions when it comes to any commercial decision. But nevertheless, it's again a confidence in the joint lenders forum, which is absolutely of immense importance. Unless and until that confidence is restored, it will be always be a concern, because I think often we were talking about the better rights of the escrow account holder, and normally they have a situation where their account goes NPA the last. So that is the kind of a situation. So unless and until an equity is built into this kind of a structure and the mechanism, and adequate trust is put in place, and adequate operational guidelines which are in the benefit of all concerned have been put in place. I think eventually the trust is something which will help in improving the coordination, and also that decision-making process. On Mr. Umarji's view that 49% and that kind of a structure, maybe all that can be resolved with the help of a golden chair also. Golden chair we already have got TVRs in the market already are there. So if at all a golden share is made available to the government which will ensure adequate control, otherwise I think that is something which can be thought of.
Tiwari, your thoughts?
What Rahul said, yes, I do consider there is a problem in coordination, because from a public sector bank's point of view, we have two regulators, RBI and DFS. To what extent they regulate, that's a different issue. And then we the banks. And to, even the stakeholders or the lenders' point, I mean, we bankers are there, ECB holders are there, FCCB holders are there, and NCD holders are there, PE is there. So there has got to be some mechanism, I wish I had the answer for, where perforce you are brought on a table to decide the future course of action. It's not working so seamlessly even in the JLF. That's unfortunate, but it's true.
But do you see this regime as being able to find a solution? Or do you think some drastic measure like a centralized AMC or a centralized bad bank is actually needed? Or you think we will slowly chug along and find a solution?
This has been debated a lot. I don't think that is the solution. And remember one thing, I mean, this problem is so magnanimous, so big, you can't find a solution in 2 months' time. It has got to be tested. Like when we talk about restructure, SDR or 525 thereafter or S4A, have we given them time to play out? No. It would take time.
I would just add, I think from an ARC's experience, we spent almost about a year or 18 months just aggregating debt. And aggregation is currently a huge amount of effort that ARC is put in, because unless you aggregate any restructuring, any additional funding, it cannot go forward. And we have been also recommending that, all sales happen through a consortium process. But unfortunately, each of the bank have their own boards, they have their own priorities, they have their own urgencies. And as a result of that, this entire, diffuse approach that is happening, because when an asset is going bad, it's very important to act very quickly. And a consortium-based approach, either through a JLF or whatever, so if it's being sold to ARC or S4A is invoked or SDR is invoked, as long as it happens to a consortium and it imposed and enforced immediately, it would be highly beneficial.
So you mean it has to be, the consortium decision should be enforced and leakage should not be allowed? Is that?
No, see, currently what happens is, Mr. Tiwari was saying, even in the JLF, all the bankers will agree, and then they still have to go back to their own boards and get it approved and ratified. Like, for example, the issue of additional funding.
Absolutely.
If additional funding has to be given, each bank has to go back to its board and then decide to provide additional funding. All this takes a long time, and there is no common mechanism that once it is agreed at a consortium level, then the enforcement and the follow-through is automatic.
I only wanted to add that as far as functioning of ARCs in the market are concerned, there is a recent amendment to SURFACE Act which has been passed by Parliament, which removes the restriction on holding controlling capital in an ARC. So it is now permissible that 100% capital of a ARC can be held by another company or any individual. It is FDI investment is also permitted in ARCs. There is a further modification that when ARCs acquire loans from banks, they also issue security receipts in favor of investors. These security receipts can be now given only to qualified institutional buyers. This requirement is also modified, and they can be now issued to any person. They need not be qualified institutional buyers. Further amendment done is that when a ARC acquires loans from a bank, there is a deed of assignment which contains the benefit of underlying mortgages and other securities which are given by the borrower to the ARC. This normally attracts ad valorem stamp duty. The amendment provides for exemption of stamp duty on such acquisition of assets by ARCs. This is expected to improve the working of the ARCs and acquiring of more assets and revive and rehabilitate many more stressed accounts in the future.
I think as far as the structural issues are concerned in terms of enabling legislations, etc., they have been very well addressed. But when it comes to the stock of the accounts which are there with the ARC, unless and until there is a resolution component on the ground which can actually turn around those assets, the ability of ARC to procure more and more account will always be impaired. So I think there is a need for another addition which has to be part of the ecosystem. We have to have people who are available to be put in the company so that the companies turn around and they start chugging and also start generating cash for the benefit of the economy.
I think one of the things that is going to happen in the next 5 to 10 years is going to be a reliance, a good reliance on professionals who can actually turn around and work out the company. Yes, you have them in India today, and that breed is growing, and it's a good breed. And I think that from a bank's point of view, you should not want to be everything to everybody and be able to do everything for everybody. It's not your core competency to turn around a company. So you should be looking out and mandating people who can. That does two things. One, that reduces your reliance on the promoter from a professional management point of view. Secondly, it allows you to download the expertise of the promoter and translate it into pockets that you think the workout team can do the best for. So I think that the new landscape is going to consist of insolvency professionals, where the rules are being written up. What is the rule of the game? If you look at the Insolvency Act, it's got a pretty it's got a sword which just sort of cuts through and doesn't give you more time. I am yet curious, or rather concerned, as to how the standalone drop-dead date is actually going to impact banks and the economy. It's all very well to say you will be automatically liquidated. What does that mean to workers, to suppliers, to vendors? And how many private liquidators are you going to get into the Indian system? So what, and just to say that this will force a binary solution has to mean a binary solution that works. Or there will be false solutions just to get out of liquidation. So I think it's a fascinating, as a lawyer, it's a fascinating work in progress. But I think the banks have to start engaging and building their ties with other professionals who can start being your workout cowboys.
On this very important piece which you have talked about in terms of creating the insolvency professionals, I mean, the cadre of an insolvency professional, it's going to be of immense value. At the same time, in the banks also, we will have to create capacity which can actually deal with such kind of stress situations, because these are very exceptional stress situations which have not been confronted by the banks in the past. For the first time, maybe in due course, the Institute of Banking and Finance can also possibly come out with some kind of structured courses which can give the required skill to the bank cadre also, how to deal with such kind of situations. More so when it comes to haircuts and how to compute haircuts. These are the realities which all of us will have to confront in the days to come.
Fantastic. So I think the next discussion around the bankruptcy code has already been covered. I think what I take away is, while it's a step in the right direction, how it will manifest, the whole ecosystem development of investment, the whole IPs and IPAs has to come up and become mature, right? And we cannot have easy binary solutions. I think the other point we debated a lot was how to enhance coordination. I think there is very clear recognition that the coordination needs to improve. Now, on one hand, there's an extreme view that unless you create, ownership solutions or separate central asset solutions, it won't solve. On the other hand, there is optimism that we are moving in the right direction, and if we can make the JLF working more tight, and we can have simple decision rights kind of rules that if the lead banker or if once agreed in a consortium, we can't go back and change the decisions, it can automatically smoothen a lot of the operational glitches. So I think we already started to discuss the next section, and I will jump to that, which is really at the end of it, we are all serving a business, right? And a business which has got a fundamental reality. So if you look at it today, right, what we see from the outside is a little bit, in this catch 22, the focus on business sort of moves away, because when the company is in a financial crisis, the promoter is actually busy trying to resolve the financial issue first and ensure that his personal interests are taken care of. Right? The lenders are obviously trying to ensure that quarter-to-quarter barking is done properly, and if they can somehow keep the account regular and and ensure that the books are maintained. What happens in that process is significant damage to business. You see exit of senior executives. You see cash begin to get prioritized over profitability. Working capital, of course, is squeezed. Secondary markets, which are more expensive, are tapped for capital. Right, customers, suppliers all begin to bargain hard, and all the discretionary spend like maintenance of equipment, etc., is all stopped, which actually hurts the asset quality in a substantial way. So what is happening in this is really business is suffering. Right. The other thing what you find is that in arriving at any decision of a business, right, one needs to really fully understand the business. Right, and in our view, there is no standard solution. There are businesses which are maybe fundamentally unviable, and they require a different solution like liquidation or asset sale or something like that. There are businesses which have actually management and governance issues which require a management change for sure. Right? There are businesses which are actually just cash trapped and they require more fund infusion. There are businesses which have more macroeconomic failure issues and not anything else. And there you have to just tight the cycle and postpone obligations and really hope and pray and work on more duty structures and other kind of tariff barriers. And then there are businesses which are viable, but they don't have the scale. And there you need to consolidate and grow to get the scale. So the question is, this is a very different mindset by which you look at a business, And in a model where we are today, right, where the promoter's equity is going to be marked down substantially, banks need to act as business owners. And banks have not done that. This is not their business. Banks have been lenders and as well claimed with no intention of becoming business owners. But by situation now, we are in a situation, they will hold equity, substantial equity in majority of these companies, right? But they don't have the ecosystem available to help in governing and managing the business. So question to the house again is how do we ensure that banks can actually act as business owners, take the right decisions for business with the help of the ecosystem, whether it is valuers, turnaround performance consultants or employees or executives. What do banks need to do to really be able to drive robust business decisions?
I think in this I would just add one small angle. And the angle is, all of us talk about operating turnarounds and workouts and all, but our own experience has been that unless you do the financial restructuring first, you can't do the operating restructuring. And all the issues we have on enforcement, consortium, too many banks in the consortium, getting agreement on that, aggregating debt, all of that, we still have issues around how to get the financial restructuring done. And up till now, all the ARCs, including ours, have largely focused on the financial restructuring, financial resolution, and then recoveries after that. If you can do that, and if you can get those issues out of the way, then getting experts, getting skill management to really do an operating turnaround. So it's not either or. You have to do financial restructuring and then you have to go to operating turnaround. But unless we fix the first one, which I hope that largely through the insolvency code and all the, will help arrive at that. Only when we get that out of the way, can you go to saying, okay, I can bring in outside management and start doing operating turnarounds. And all the smart ARCs have started investing in that. And there are a few examples that are underway. But our own experience has been that unless you spend a year, year and a half on aggregating debt, getting the financial restructuring done, getting additional, some additional liquidity into the company, getting all of that out of the way, agreeing how the equity will be shared. Because at the end of the day, as you said, even though the banks say that we are not equity owners, we are only credit providers, the more you write down credit, the more you are actually creating equity value. As you reduce debt, you are increasing equity value. So there is a trade-off that is involved, and unless we get that part out of the way, you cannot go to step 2.
So I think you're rightly saying there is not a either or, both need to be done. Right? My question was more around the latter. If and when that time comes, and if banks end up being owners, how do they ensure that they have the right ecosystem to help them manage the business?
Yeah. You see, we have to consider the provisions of the insolvency code for this purpose. The bankers have a very challenging task in the years to come. In terms of the insolvency code, immediately on default, if I commit a default today, tomorrow an insolvency petition can be filed against me. My default will be verified. If the default is confirmed, the court has to pass an order for insolvency resolution process. Once that insolvency resolution order is passed, the insolvency practitioner is appointed. He is supposed to take possession of all the assets. He is also supposed to take over the management of the company and run the company as a going concern. Now, this in effect means that the bank may have to take a possession of, through the insolvency practitioner, a poultry farm or a company manufacturing hazardous chemicals or a huge petrochemical project. Now, how do you create capabilities of doing this kind of exercise? This is going to be a major challenge, and it's going to be a stumbling block that because I am unable to do it, I will not go to the insolvency court and get an insolvency order.
Yes, it's a fair point. Mr. Tiwari, you were going to say something.
You said about the owner. Look, bankers could be catalyst, not the drivers. I don't know, you can tell, you or Mr. Umarji, can we be as a banker business owners? It's for the government and the regulator to create that ecosystem which makes us conducive for the resolution. We'll remain the banker. We want to remain the bankers only.
But if you do a markdown of debt and a lot of the debt is converted to equity and we don't have a third party investor coming in, you are the owner, you like it or not. And unfortunately, right, I don't think that you want to be one.
If there could be accidental prime minister, we could be accidental owner also.
But I think even in the leading up to this situation, there is a strong role, all of you highlighted offline, that the ecosystem needs to play in helping banks take decisions on whether a project needs to be funded, an investment needs to be done or not done.
See, I think it's important to not confuse equity ownership as a financial decision as ownership over control of the company. So I think we need to segregate the two. So I can see a scenario where banks can own 80% of the company and still not be operating owners of the company. And I think if we get there, then all this becomes very easy, because then the equity ownership is only a financial decision. It is not a decision to start becoming promoter of a poultry farm.
That exactly, Rashesh, is what I said earlier. Banks may be forced as a pro tem measure to acquire equity, but they will have to reach out to professionals who will be running the ship for them and cause as little loss as possible and try and stabilize the operations. And I think no prudent banker would be converting into equity without having some sort of soft backup plan. And therefore, the M&A opportunities for the investors at large is going to be very interesting. It boils down to how much of a check they're willing to write and how much of a haircut the bankers can actually take.
You see, there is a concept of debtor in possession in the bankruptcy laws which are applicable in USA and other countries. In our insolvency code, that concept is not provided for. So as a result, the bank itself has to take possession through the insolvency practitioner and substitute the creditors committee for the board of directors of the bank and manage the show. Now one other solution to this entire problem is the promoter himself becoming proactive. He is running a business. He is supposed to know that there is going to be a problem. I am likely to commit a default. It is for him to inform the bank that this is the problem. May not be able to service the loan in the coming months, and this is my problem. Come clean, give full facts to the bank, and try to start working out a scheme for revival and turning around at the outset, so that the bank also has a confidence that this man is coming with all his difficulties, and there may be some possible arrangement which could be worked out, that the insolvency practitioner appointed is with the consent of the promoter as well as the bank, and he runs the business as a going concern.
So I think it's a fantastic set of inputs. I think we are under time pressure, so I would like to conclude the discussion